All right. Good afternoon, everybody. Welcome back. Hope you guys had a good week. Let's just get right into it. First, I just want to go over what Renaissance wants me to tell you about. So today's forum will be at Amador Room 153, Building the Future of Public Media. But today, we're going to talk about, now that we kind of have an understanding of what we're going to go into, the whole deep process, we want to start off with just looking at, are there any red flags? Are there any big holes we need to fill? What are the things that we can get out of the way right now before we dive into anything complex like tax planning or investment planning on the detail basis? So there's a couple problems that we want to make sure that we address or that we solve for. So we want to make sure we have enough money. Obviously, that's kind of the big one, is to make sure that our money is enough and that it's going to last for the time period that we're hoping to plan for. We want to take advantage of all the tax deductions that we can, any other advantageous things that we can do tax-wise, because if we can use 80% of our dollar instead of 70%, that's going to contribute towards having enough money in retirement. That's going to make a big difference. And then the last thing is really an accident can undo a lifetime of investing. And this talks about a lot of different things. This could be an investing mistake. This could be an insurance coverage that isn't met. This could be an estate planning mistake, that maybe assets go to the wrong place, they get taxed too much, or it just isn't used efficiently. We're not in the right way. Oh, okay. Okay. All right, hold on. We just got a technical difficulty real quick. You got it over here.
Can you reach PC?
Yes, I can. All right. Good? Okay. All right, and we're back. Okay, so we're going to, again, our breakdown is sort of like this. 3 phases. First, we take a look at our basic financial planning. We just make sure that we've taken care of the bases, that we make sure we have enough insurance coverage, we make sure our tax planning is good, we make sure our estate planning is at least workable for what we're trying to achieve. Then we'll move into the investment portfolio. Then we'll move into the more, after the fact planning maintenance. So what we're going to start with is what we like to call the diagnostics. And like I mentioned last time, we name it this because we like to think of it as kind of like a health checkup for your finances. We're just checking to see if anything is blatantly wrong right now, if there's anything that really stands out that we need to address right now today. Because we want to make sure that you can make really sound investment decisions. I could show you how to save a little bit on fees and make sure that your risk is adjusted, but if we don't address the big things, that's not going to matter so much in the long haul if it gets chopped down by 30 or 40%. So we'll start first with cash flow diagnostics. So this is going to talk about when you have money coming in and money going out. It's very important to understand what's feeding what shortfalls we have to come up with from investment assets, and sort of how that all works together. So the personal cash flow diagnostic, we want to think about a couple things. We want to think about, is your income going to increase in retirement? Is it going to decrease significantly from where you are right now, whether you're in retirement or not? How is it going to change? How are the expenses going to change? Or is there going to be a higher expense for healthcare? That's a possibility. Is there going to be a higher expense for traveling, for vacation, for anything discretionary that we might think we want to do? Cash flow planning is really important. And, budgeting is something that feels really boring now, and it's probably something you've already done. And even if that's the case, it's just important to have a really good understanding of what the expense need is, because there's no way that we can put together a portfolio, put together a plan that serves a completely undefined goal. So it's an easy thing to do, but it's also an easy thing to overlook. So it allows us to project our income forward and our expense growth, or anything that might change in the future, and be able to plan for that, be able to run simulations through financial planning software if you work with an advisor, or just through some simple napkin math to have an idea of how well we can service our needs. So there's a bunch of different ways that we could have income. Stuff you'll be familiar with. Obviously, when you're working, or if you're still working, W-2 wages are something we can consider. Self-employment work, anything contracted, Social Security payments, pension plans, annuity payments, and then investment distributions if you're taking them. You might be taking some earnings from a taxable account. You could be taking required minimum distributions from those IRAs and 401ks that built them up really big. And you might not be thinking about it, but the investment distributions, when those RMDs come in, that's going to be a forced bit of income you have to take regardless. So it might be a thing that you're not even planning to need, but you're going to have to take it anyways, and it's going to be important for tax planning later. Expenses are the flip side of that, the things that are really important. Of course, all the basics: housing, healthcare, groceries, monthly utilities, all of the normal stuff that you're used to. But it's really important to include this last one. Fixed expenses are, of course, important to plan, but they're the things that you've planned for very easily up until this point, I imagine. Leisure activities and traveling and discretionary spending is probably going to increase as we move forward in retirement, because either you're going to realize, okay, I'm sitting on a little bit of assets, I need to do something with this, or you're just realizing, I want to do something while I'm sitting here retired. I don't want to just be sitting on the couch watching TV all day. I want to do something. So it's important to budget that in and budget how it could grow. If there's big one-time expenses, if you want to take a big trip in a couple years, it's important for us to plan for that. And it makes it a lot easier to give us a lot of confidence as we go forward with our plan. So one of the handouts that we gave was a budgeting sheet. So if it's something that you haven't done recently, just go ahead and take this home and just get your budget done, whether for both your current expenses and projected. You could use a year from now, 5 years from now, whatever you need to plan for. So make sure that you're generous with your assumptions. If you're a little bit overshooting on what it's actually going to cost you, that's only going to help, because it'll create a surplus. So future expense planning, it's really important to think about all of this in different time frames, whether it's a year from now, 3 years from now, 10 years from now, or 20 years from now, whatever your time frame is. Don't forget that these costs are going to increase. You've got to assume inflation is going to continue, because I don't think that we're going to have zero inflation over the next 10 years. It's probably going to be pretty substantial, so make sure you're accounting for that. If your investments are growing, especially those IRAs and those 401ks, those distributions will also grow. And they will also grow due to the fact that the time frame that they're being calculated on gets shorter and shorter as you get older. So that income source is going to increase. Cost of living adjustments might be applied to something like a pension. There's just a lot of ways that income and expenses can change, and it's important to keep those in mind. So all this information, as boring as it sounds, as much as it sounds like easy personal finance stuff that should have been handled many years ago, it's still important to consider and be able to have a couple different benchmarks that we can work with so that we know what we're planning for. Time value of money is probably going to be the most valuable calculation you could know how to do if you want to learn how to do any of this yourself. The time value of money is just a simple financial calculator that's used all the time, and it allows us to solve for one of 5 different variables. So we've got our current capital, or the current value, present value of whatever sum of money we're talking about. We've got the future capital, or future value of whatever sum we're talking about. We have whatever implied investment return there's going to be. There's a way that you can calculate a real return with inflation as well. And it's just kind of like being able to see, if we have a portfolio invested, we have an idea of it's worth $1 million now, maybe we want to keep $500,000 at the end of the day, and it's earning 6%, and then we plug in a time horizon, whether it's 10 or 20 or 30 years, and then our payments in and out. So we can solve for any of these, assuming that we have 4 of the 5. So you'll always have one that you want to look for. Usually it'll be, how much do you need right now? How much are you going to have left over? How long is this going to last? Or how much can I take? Or do I need to put back in? And so it's a really simple thing. You don't need anything fancy to do it. You can just look up a financial calculator or time value of money calculator on Google. You'll very quickly find a bunch of different options. You just plug in each of those numbers and you can solve for one. So this can help us with a lot of different things. It can help us with how much money do we need? It can help us with determining how much risk do I need to take to actually earn enough return over the timeline. So what's required? You might end up looking at the plan and going, okay, I need this much per year. I need it over this amount of time. And wow, I only really need to earn 3 or 4%. You could be a lot more conservative than you're expecting. Or you might see that a really high number of required return and understand that, okay, maybe I need to tone my distributions down a little bit. A lot of ways that that's useful. So let's look at a couple scenarios so that we can sort of understand how this calculation happens. So we'll look at our first scenario, which is an investor that wants to generate $50,000 a year for 20 years. And at the end of the 20 years, we're assuming the assets go to zero. We're going to spend them all the way down. No beneficiaries, nothing to take care of. We're just going to start with a dollar amount. We're going to spend it all the way down over the next 20 years. We're going to assume that their annualized average rate of return is 7%. So there is one flaw with this, is that you're assuming that the rate of return is the same every year. And we know that that's not going to be reality, but it still gives us a really good benchmark upon which to plan. So the result of this calculation, if we were to plug in those things, which is we don't know what the present value is, that's what we're solving for. Our future value is zero. Our time horizon is 20 years or 20 periods. And we're taking $50,000 a year per period. With a return of 7%, this investor needs about $530,000. Now again, we probably want to be a bit more generous about this, because if we actually saw real sequenced returns every single year, there's probably going to be some years that are not quite 7% or that actually have a negative rate of return. So a bit more complicated planning softwares can do that for us, but this is just helpful for us to get a baseline of where we're trying to go. Scenario 2. Let's say that investor now realizes, okay, so I need $530,000, but I need to get there from 150, and I need to do it in 10 years. Assume that absolutely no money is going to get added, so we're just trying to add this to the stock market, let it ride, and hopefully it gets there. And then we see that we require an average annualized return of 13.5%. So this person's probably going to realize, all right, maybe I need to save a little bit for the next 10 years. Maybe I do actually need to add a little bit of money, pull that required rate of return down so that it's a little bit more achievable. And you see how immediately just a couple of these calculations can help sort of calibrate us and give us a reality check if we need one. So for emergency funds, this is a really easy place for us to start. This is the kind of money that before we even think about what we're doing with our investments, before we think about what we're doing in any other way, we need to make sure that we have a liquid cash fund to take care of emergency expenses. Now, the general guidelines are roughly 3 to 6 months of your non-discretionary expenses. So all the stuff you have to pay for, what keeps the bills on and keeps you alive. We want to make sure we have 3 to 6 months of that. If you want to feel really good, go ahead and just do the full year. You can invest it in treasury bills or CDs or a high yield savings account and still get a little interest. But you generally want to have a minimum of 3 months, an average of 6, and if you want to feel safe, 12. And that's also really important to include insurance deductibles in this amount, because that's the amount you're going to have to pay before coverage kicks in, period. So we need to make sure we have that cash on hand. Our co-pays as well, even when insurance kicks in, if it's not covering 100%, there's going to be some bill to pay. So it's important that we have maybe a rough idea of what our average co-pays could be per year. And then, of course, we don't like to have them, but there are surprise home repairs that come out of the blue. And it's important, you might not keep this directly in your emergency fund. This could be part of your portfolio, but it's important to sort of think of that ahead of time so that a big expense doesn't come in, immediately wipe out all of your emergency fund, and then if something else happens, you got nothing to spend with, right? So we want to plan for a couple contingencies all at the same time, rather than just the standard 3 to 6 months of expenses, and then that gets wiped out by a surprise repair. So moving on, after we've kind of thought about cash flow, we're just making sure we have our budget down, we know what we need, we know what we're planning for. Now we can think about taxes. And the reason that I pull up taxes now is because it's directly going to affect all of that cash flow planning I just talked about. If we're taking $100,000 of income and it gets taxed at 20%, well, I'm not spending $100,000 of income, am I? I'm spending 80. So there's a difference between what I'm taking and what I'm spending, and that difference is pretty much always going to be taxes. So there's a couple things that we can look at just to be sure that we're not completely draining down our income sources and ruining our spending power by getting taxed too much. So the first thing is the easy stuff. Are we taking advantage of our current tax deductions? Standard deduction will cover a lot of people, but it's important to evaluate if itemizing actually is helpful. So looking to see if you do actually have those additional expenses, and maybe meeting with somebody that can help you determine that. Making sure that we get taxed at preferential rates when we can. So really kind of the easy way for me to demonstrate this is if we have 3 different type of investment accounts. If I have an IRA, if I have a taxable account, like a trust account or an individual brokerage, and then I have a Roth IRA, those are all going to get taxed very differently. And if we just pull from the IRA with no thought about any of the other accounts, well, we're going to get taxed at our highest rate possible. Is that appropriate? Well, it could be if that's the only income that you're taking, but it's likely that maybe we want to fill up some tax brackets to a certain level and then start to pull from some other place. Because just for example, I mean, the tax bracket jump goes from 12% up to 20%. So if we're filling up the 12% bracket, we could potentially stop there if we can, if our RMDs don't push us above there, and then we can look over to something that gets taxed at a preferential rate like long-term capital gains. And that might only get taxed at 15%. Maybe not even that. Maybe you get the 0% rate. So if we move over there, then it means that we keep more of our dollars after taxes. And that's really important to make sure that we can actually cash flow our needs. Tax-efficient investment products are kind of the last part that I want to consider, and that's mostly talking about things like tax-free interest, which only really makes sense for most people once you hit that 32% tax bracket or higher. Because when we look at that later, we'll see that there's a little bit of a deficiency if you're using municipal bonds or anything like that in a low tax bracket. You're just kind of giving up money, and it's not really saving you much in other places. And so then, of course, are you prioritizing the right investment distribution sources, like I just talked about with that tax bracket example? Are we doing capital gain or loss harvesting when it's appropriate? And are we using the right charitable contribution sources? Again, if we pull back to that idea of a couple different accounts that we could pull from, let's say we want to be charitable. We could take money out of our IRA, not pay any taxes on it, and contribute cash. Fine. We could take stocks out of our taxable account and contribute them directly to a charity or a donor advised fund. Fine. We could also, if we have RMDs coming up or we just want to donate some money from our IRA, we could do a qualified charitable distribution that way. So which one's going to be the most beneficial tax-wise? Well, if we look at how each of those products are taxed, the Roth IRA doesn't really give us any benefit for doing that because we already wouldn't have paid taxes on that income. If you need the deduction against other income, that's fine. If we take it from the taxable account, we could avoid some capital gains and just kind of push over some shares. That's pretty good, but if you're taxed at 15%, that's a preferential rate we might not want to give up. But if we take it straight from the IRA, that's your highest possible tax rate that you could ever pay. And so if we have the choice between them, we're probably going to lean on the highest tax asset to push that money over because it's going to give us the best net benefit. So in terms of deductions, there's a couple things that we could look at. Obviously, if you're still employed, you've got your traditional IRA contributions and health savings account contributions. Those are tax deductible above the line. Don't need to itemize for those. And now if you're self-employed, you also don't need to itemize, and any of those business deductions go right against that income, including those self-employment tax and business use of a home or a vehicle. So if you're running a small business out of your garage or your office, hey, you could take that square feet deduction. A couple other above-the-line items, student loan interest. So some income limits apply. At some point, it's not going to be deductible anymore. Alimony pre-2019 agreements, those will be on there, and penalty on early savings withdrawals. So if you're paying a penalty for taking money out of a retirement account too early, you actually can deduct that little penalty on your taxes. You're still paying the penalty, which is kind of rough, but you get to have that little tiny deduction. A couple other deductible expenses, and all of this was just pulled off of the IRS website. If you want to find that, you can just look up deductible expenses on irs.gov, and you'll get a nice, big, long list of a bunch of stuff. So for example, bad debts. If you created a loan and that went belly up and somebody's not paying you back, you can write that off and you can have that as a loss. Capital losses. If we go back to that taxable investment account, if we have losses that we realize in the current year, we could take about $3,000 of that every single year and write it off against our ordinary income. So that's nice. That's, again, that highest tax bracket that we get to reduce a little bit. But we have that limit of $3,000 a year. But thankfully, we can take any excess capital loss that we have and continue to carry it forward in perpetuity and use it over and over and over again. Now, donations to charity. Oh, yes.
Are you taking questions now, or should we wait?
Oh, you can go ahead and ask.
Oh,
That's all
okay.
right.
I have a question on the
Yeah.
donations to charity.
Yes.
On the thing it says the non-itemizers up to 1,000 or 2,000. So if you don't itemize, you can still deduct up to $1,000 or 2,000.
Correct.
On your taxes. If you do itemize, the 50% of AGA for cash. So because like if you do RMDs, you can donate to charity through your RMD and you get that break.
Yeah.
Which lowers your taxable income, I guess. But then what's this other, the 50%? So if you donate more, you can, other than through your RMDs, you can.
So here's how that's working. The qualified charitable distribution is kind of its own thing. It gets to exist sort of in its own place, and it has its own limits, whatever. If we're talking about donations to charity out of your taxable income, because with a QCD, it's like you never received the income in the first place. So these other rules stop really applying to it because it's just not a part of that conversation. But here, if we're donating cash, we can only donate up to half of our adjusted gross income. So that's after those above the line deductions. We can't donate more than half of that. And then if we're going to donate stocks or mutual funds or ETFs, we're limited even further, only up to 30% of our adjusted gross income. Because the idea is you're not supposed to be able to just write off all of your income by taking a certain amount of income and then donating the same amount of assets out of an investment account. Because you would just basically be completely offsetting your taxes in that way. So it's just a little bit limited there. And then with the bill that passed recently, non-itemizers get to have their own little deductions. It's small. It's $1,000 for single filers and $2,000 for joint filers. But it is something a little bit extra that we get to use. So if you take the standard deduction, and who knows, maybe you take a lot of stuff to Goodwill and you get those receipts. You could add those up and still deduct them even if you don't itemize. So that can be kind of helpful.
And that's over and above the standard deduction.
Yes, correct.
That's
Yep.
above the 16,000 or whatever.
Yeah, yeah. So the standard deduction will be its own thing. You get to layer this on top,
Okay.
along with the enhanced senior deduction that also came about recently. So you get to stack all three of those on top of each other and get a pretty hefty tax
And
savings.
that's all separate from RMDs if you donate to charity.
Yeah, I believe so. Yeah. So home mortgage interest, I'm sure you're very familiar with this concept. You can write up to interest on up to $750,000 of acquisition cost. That basically just means it has to be a mortgage that was used to acquire the house. So you can't pull out home equity line and then write that off. But you can use that. So if you acquire $1 million property, you take a $750,000 mortgage, you can write off all the interest. Anything above and beyond that, though, won't be tax deductible. So income tax, sales tax, real estate and personal property taxes will also go on that list if you're looking to itemize. Medical and dental expenses above 7.5% of adjusted gross income. So we actually need to meet this threshold first, and the first 7.5% is not tax deductible. Then if we go beyond that, then we get to write that off if we choose to itemize. So it's a couple things layered on top of each other that determine whether we get that deduction or not.
Nash,
Yes.
can you give the definition of AGI? Because everybody doesn't.
Yeah, so adjusted gross income, here, let me make sure I read this perfectly correct, because this stuff always,
All these
it,
acronyms, they get scrambled.
I know, it
Bottom line.
it confuses me sometimes as well, but yeah, it's, okay. So it's pretty much your top line deductions that come right off of it. We don't get down all the way to all the itemized deductions and whatnot. So it's going to be, yeah, again, it's just you take that total taxable income, and then you take those initial adjustments off. So yeah, it's just kind of like that first level of adjustment and not, you know, the stuff below.
If you're doing standard deduction, it'd be your
Yeah,
gross
pretty
minus
much.
that before we get
Yeah.
into
Yeah.
additional stuff.
Yes.
As a follow-up question, isn't there now a threshold that we cannot deduct for charity donations?
For what?
Can you repeat that?
There's a question if there's a threshold for where we can't deduct charitable contributions. I'm not aware of such, but I will check it out and see if that applies. Yes.
This is the next question from Zoom. Is mortgage interest on a second home tax deductible?
Yeah, is it? It should be. Yeah? Yeah. Okay, yeah, I thought so. It is. Okay. So here's a couple other things that we can think about after we get past our deductions. So are the investments generating income that's affecting our plan? What does that mean? Well, there's a couple things. One of the things that's important as we look into tax planning, going into retirement, is not just what level of taxes am I paying? How predictable is that year over year? Are we able to have a consistent tax schedule as we move forward? Or are we going to get surprised by a big tax bill that suddenly increases taxability of other things? If you know about how Social Security gets taxed, for example, first we have to figure out how much of it's taxable in the first place. Now that gets affected by all sorts of things. That gets affected by ordinary income. So if you're taking IRA distributions, if you've got a pension, that affects it. It's impacted by capital gains and dividends. Those will also add to the calculation. And it's affected by half of the Social Security benefit itself. And finally, it's also affected by tax-free interest. So a municipal bond is not actually going to help you in your Social Security taxation. And now, the thing that we want to think about is, especially in taxable accounts, in individual brokerage accounts or revocable trust accounts or anything of that sort, one of the things that creates the most unpredictability when it comes to our tax schedule are mutual funds. Mutual funds that are a little bit more active in nature, that might send out capital gains distributions. Now I'll tell you, I had a client, she has a pretty large investment account, and she doesn't really take anything from it. She just kind of lives her life on her fixed income and isn't worried about what happens in the investment portfolio so much. So we just try to make it not too taxable. But there are a couple mutual funds in there that, if sold, would generate a lot of taxes, but they also generate taxes from capital gains distributions, because the managers will buy and sell inside the fund however they determine that it's worthwhile. And if they have a net gain at the end of the year, they got to send that out to all the shareholders. And so her account ended up having about $250,000 of capital gains distributions and dividends. Stuff that was not generated from sales, stuff that I didn't do anything to create. It just happened because the funds that she was invested in kicked out a whole bunch of capital gains. So what do you want to bet that did? Well, it did two things. It bumped up the taxability of Social Security, and it increased Medicare premiums. It's a little bit of a sting. So those are the things we want to look at for predictability. We just want to make sure that if we have a level of unpredictability, okay, can we think about a way that would be tax efficient for us to deal with that now, figure out some way to unwind these positions? Yeah.
I am a little confused on how all of this affects your Social Security.
Yeah. Okay.
How can all of this, so you're saying Social Security itself has all these funds that it invests in themselves?
No. So Social Security, as an income source, there's one calculation that has to happen before you determine how much tax you pay on it, and it's how much of that Social Security gets taxed. So from your income sources, ordinary income, capital gains and dividends, and half of the Social Security, and tax-free interest, all of those get added up into what's called provisional income. And then however much provisional income you have, you hit certain thresholds or go beyond them, and that helps determine how much of your Social Security gets taxed, and then that amount of the Social Security gets taxed at your ordinary income rates.
Capped at 85%.
Yeah, up to 85% of it gets taxed.
The good
Yeah.
with them is if you have a pension, you're going to be paying.
I'm
Yeah.
sure, and there are required minimum distributions
Yeah.
this year, which upped something, so now I'm paying more for my medical.
Yeah, so that'll also, so that would have increased the taxability of your Social Security. You might have had 50% of it or 60% of it be taxable, but now it's up to the max of 85. And then additionally, that also adds to your modified adjusted gross income, which is we take that adjusted gross income and we add back tax-free interest. That is now the number that's used to calculate what your Medicare premiums are. So I did a tax planning seminar not too long ago, and this was like, this took up a decent amount of time, and there's like 4 different income sources that we use to determine like our tax rates and taxability of benefits. And it's a mess. It's an absolute mess.
But after all of this is done, all the messy stuff.
Yeah.
Whatever amount of your social security that is taxable based on your regular tax.
Yeah, right at your marginal income tax rate. Yeah, so it'll be at your highest rates.
32% is taxable.
Exactly. Yeah. Yes.
Can I ask, how does Social Security know this?
Yeah.
Well, I
They
mean,
know everything.
they know everything about us all the time, and they just wait for us to make the mistake.
Is
You know.
that based on our yearly income tax report?
Yeah. Exactly. Yeah.
All
Yeah.
right.
So you know.
Just one follow-up question now.
Yes.
In the example you were giving of the client, was that capital gains coming out of her, was it a brokerage account or was
Yeah.
it her IRA?
So that was out of a brokerage account. Capital gains that
It
get
wouldn't
shot
have
out
hit
to
you
right.
if it was an IRA.
Because if we're talking about an IRA or a Roth IRA, the IRA is not going to hit you until you actually take the funds out, at which case it's all taxable at marginal tax
Doesn't
rates
matter
anyway.
how you got the
Yeah,
funds.
doesn't matter. None of that matters. So this is only for taxable brokerage accounts. So like revocable trusts or individual accounts or joint accounts, any of that sort of stuff that's taxable when the money hits. And so if we have, you know, some funds that we want to keep that might distribute assets or distribute capital gains like that, it's much better for us to keep those for predictability's sake in tax-deferred accounts or tax-free accounts, so any sort of tax-advantaged account. That also comes with the trade-off that once we put it in there, in a Roth IRA, it'll be tax-free, not too bad of a deal. But if we put it in an IRA, it goes from maybe being taxable at long-term capital gains rates to ordinary income rates. So there is a little bit of a trade-off there. So it really just depends on how big are these distributions. It's a lot of coordinating to do and a lot of things to know. And it's hard to predict because those distributions are always a different size, right? Like the year before that $250,000 distribution, it might have been like $50,000, which for this size of client's not a big deal. But then it was, 2023 was pretty small, and then 2024 was a giant bull market for this fund, and they were just rotating out of those positions. So it just was an absolute massive tax liability. So we want to make sure that we're optimized for tax predictability in some cases. We don't necessarily want to give up our best rates, but we want to know that if we have a plan, we want to make sure that things are relatively consistent within the things that we can control. So there's obviously going to be constraints. We can't control exactly when healthcare costs happen. We can't control exactly when tragedies happen. We have to pull giant amounts of assets and pay for things. But maybe our investments and our income sources can be coordinated in a way that's a bit more predictable. So moving on to real estate. There's a couple real estate deductions that we can get on the personal residence. Like we mentioned, we have that $750,000 of debt. That interest is deductible. Loan points in the year paid on the first mortgage can also be deductible. Property and state taxes can be deductible within certain limits. Recently, that was limited to $10,000, but that was increased all the way up to $40,000, a 4x increase in the amount that you can write off for property and state taxes. So if you've got a pretty big personal residence, that might be important for you this year. That's called the SALT tax, state and local taxes. So if you put improvements into the personal residence, you don't get to deduct them right away, but what you do get to do, and this is improvements, not maintenance, right? It's only things that increase the value of the property. Keep those receipts and keep that cost logged because that can actually increase your cost basis. Now your cost basis is whatever you paid to acquire the property, the amount that you had to actually pay for the property, plus the commissions, any other fees that came along with that. And then if you have improvements, you can raise that number a little bit. So if you have a $500,000 home and it's looking to sell for $1 million, well, if you had put in $250,000 of improvements and you didn't log any of that, you didn't take any of that into account, that's $250,000 that's still going to be taxable at capital gains rates. But if you logged that and you kept track of that, you can take that and increase your basis, and now it's only going to be the gain from $750,000 to $1 million instead of the full $500,000. Now, additionally, you have what's called the Section 121 capital gain exclusion. This is something that you get for your personal residence, assuming that you live there for 2 of the last 5 years. So if you've lived in a home for 2 years or more, then when you go to sell as an individual filer, as a single filer, you can actually exclude up to $250,000 of capital gains and not pay any taxes on it. And if you're married, you can exclude double that amount, so $500,000. So if you buy a home with your spouse and it goes up by $500,000, you can move and sell whenever you want, and there's going to be no taxes, absolutely zero. This is one of the reasons that personal residence real estate can actually be quite tax advantaged. That, including the loan interest, can be pretty big deductions on the cost of that property. And then additionally, similar to taxable accounts, trust accounts, any sort of brokerage accounts, you get a step up in basis when you pass. So if you leave a piece of real estate to a beneficiary, their cost basis, when you die, jumps up to whatever the property is valued at your date of death. And so that also eliminates those taxes. So if you're holding on to a greatly appreciated piece of real estate, if you can hold on to it for a while, it's not too much of a pain to manage, then you can actually pass that on as a pretty tax-efficient inheritance because it will step up all the way and they won't pay any taxes if they sell it immediately. Yes?
If you have a rental property, you've had for like 30 years, can you move into that for 2 years?
I've actually seen plenty of people do that. Yeah, so you can move in. Yeah, so, well, the thing is you have to realize you're still going to have depreciation recapture, right? So if you've taken depreciation over a long time, that doesn't magically go away. So you're still going to have that because you would have written down your cost basis over time and lowered it by a lot. So you can still use this capital gain exclusion, but you're still probably going to have a lot more capital gains to deal with. So it's probably more efficient to either hold on to it and leave it as an inheritance asset or to 1031 exchange it into a new property and move the cost basis over. That's something that we'll talk about in this next slide. Yes?
Okay, what about sidewalk repairs? Is that part of the improvement for your house, or is it property, or does it not?
I think anything that's like a repair or maintenance is not considered an improvement. It would have to be something that's above and beyond what exists, and I'm not sure if it's outside like that, if that counts. You got it? No, okay, no. So now when we talk about rentals, and this question is timely, there's a couple additional things that we can do when we have rental properties, because now we have to understand that we're thinking about these tax deductions more like a business. It's less like a personal deduction, and it's more like a small business. So we have loan points, only deductible ratably over the life of the loan, so you can't deduct them all up front. You have to actually spread them out over the life of the loan. Mortgage interest, again, property taxes, insurance premiums, and you can see all of these things are kind of like it's the cost to maintain getting the income. Whatever keeps the property up and able to get the income, you can write that off kind of as a business expense. Now additionally, I mentioned that 1031 exchange. If you're not familiar, a 1031 exchange only applies to rental real estate. You don't apply this to your personal residence, but what you can do is if you find a qualified intermediary and you allow them to help you locate a property and move the funds from a purchase, you essentially get to sell your previous property, buy the new one, not pay capital gains taxes on the old property, and whatever cost basis you had built in, so whatever depreciation you took, whatever that cost you, you would just kind of scoot it over into the new property as if no sale happened and you just kind of moved over. So this means you get to defer capital gains taxes pretty much indefinitely until you decide to actually exit. And the most beneficial where this can be is if you're looking to leave real estate to a beneficiary. Because if you keep transferring, exchanging, and exchanging to bigger and bigger properties, and we just keep going and keep going, keep deferring the taxes, and then eventually we pass, well then the beneficiary gets that final, most highly valued and appreciated property tax-free. So that's why people like real estate a lot. There's a lot of tax benefits that you can get from these. That's that step up in basis at death, again. Now again, there's a couple limitations, but honestly, it's pretty generous. So under this, you have to exchange what's called a like-kind property, which basically just means it has to still be a piece of rental real estate. So you could go single family into single family, you can move single family into multifamily, you can go all across all of these different asset types. I honestly thought it was going to be more restrictive than this, but you can just pass around all of these different types of assets, even to raw land. Now there may be one thing here that you're not familiar with, and that's called a DST. It's called a Delaware State Trust. It's kind of like a limited partnership. So if you're going to partake in this, you have to do a lot of due diligence. But the idea is you can 1031 exchange from your rental real estate into a limited partnership where somebody else manages all the real estate for you, and you can move your cost basis, you move everything in there, and potentially you can sell off little bits of interest in the partnership at a time rather than realizing the sale all at once. It's a little bit complicated, and it's not something I would recommend you jump into blindly, but if you really want to have an exit and you don't want to exit all at once, it can be an option. Oh, right. Next thing. If you want to do an exchange, don't close on the property and take the cash. You need that qualified intermediary, because the moment you take cash into your hands, you void the ability of doing a 1031. So make sure that if you want to do that, you get engaged with a qualified intermediary before you start the closing process. Otherwise, you're not going to be allowed to, because you don't want to have what's called constructive receipt, which is where you receive the capital for the property. All right. So moving on to part 3, we want to look at our, oh yes, go ahead.
I don't understand exchanging like-kind property. Who
Okay.
are you exchanging with? What are you exchanging it for?
So you're exchanging a piece of real estate for another piece of real estate.
Okay, like my daughter and her husband and kids could live in my big house and I could live in their house instead?
Well, so it has to be with rental real estate, so it's not applicable to personal
Oh,
residences.
okay.
Yeah, this is just with rentals.
Oh,
Yeah,
okay.
yeah.
And for the qualified intermediary, where do you find these?
So I know that some of the large investment firms, like I think Fidelity, they have a couple of their own representatives, but that could be something you could look that up pretty easily on the internet and find somebody nearby. There's a lot of them. I remember I met with somebody. I can't remember what his name or his company is, but if I did, I would tell you. All right. Now let's think about investments. Now I want to preface this with, we're not getting into the nitty and gritty of investments right now. We're focusing on the high impact stuff. So what's the high impact stuff? Well, it's that tax predictability that we talked about before, but it's also just kind of being calibrated on risk. So there's a couple things to see here. This is a chart that shows a couple crises that happened in the stock market. Now, it's hard to read over here, but if we look to something like the Great Recession, that's a pretty strong drop. And while we do recover by more than enough over the long haul, the important thing to understand is that when these drops happen, they can affect your plan greatly. If we retire and our first distribution happens right when the stock market crashes, that could have a pretty strong impact on how long that portfolio is going to last. So that's why it's important for us to keep cash reserves and for us to invest over the long term with all of these scenarios in mind, because we need to be able to sit through these. Now, kind of on the flip side of that, if I were to talk about the benefits of staying invested even through these worst days, if you're invested every single day over the last, from 1980 to 2022, if you've invested $10,000 initially and you stayed invested for every single day, you never sold, you just bought and held, you'd end up with almost $1.1 million. Pretty good return, long time frame, pretty decent. But if we miss the best 5 days, single days, we're not talking about weeks or months or years, and this is over a 42-year time period, our investment return, or our final investment value, drops to $671,000, $411,000 of missed gains. And then if we miss the best 10 days, we miss out on almost $600,000 of gains. If we miss the best 30 days, 1 month of 42 years, 1 month of 42 years, we're all the way down missing out on $900,000 of gains. And if we miss the best 50 days, we miss pretty much the whole $1 million. So while it's important to understand what a downturn could do to us, it's also important to understand what the benefit of sticking through them is as well. Because I'll tell you that these best days that we're talking about, they don't often happen during a bull market. They actually happen right after a bear market. These days typically happen right after the trough, right after we've gone down the most. You can see that. You see these really strong spikes downwards And then it kicks back up with pretty strong momentum immediately afterwards. It levels out after some time, but those best days typically happen right after the worst ones. So while, you might get scared on a big drop and think, this is my time to sell, I just need to get out, you either want to sell before that is ever happening or stick through it, because you're going to handicap yourself in the long run. And it's over the long haul that we need to make sure that we're keeping up.
Now, our long haul isn't as long haul.
That's
as
true.
A lot of younger people.
That's true.
So I'm assuming that, like, when you are doing financial planning for people, you take that into consideration.
That's correct.
I don't have 42 years.
That's correct. And that's typically why, when we're having this conversation, it's important to understand that this is, of course, based on an all-stock portfolio. This isn't going to be you. I know that this isn't going to be you. But it's still important because once we have our risk tolerance defined, once we have an idea of how we're invested, the main argument that this serves is not necessarily that you stay invested with 100% equities for the rest of your lifetime, but it's that once you figure out what works, you need to stay with it. Because if you change things during market volatility, you're probably going to drastically reduce the probability of the positive outcome happening. So even if you're invested only 30% in stocks, it's important that when the stocks drop, you don't immediately offload all of them and move everything to fixed income. So you want to, no matter how much you're invested, you want to keep the principles of somebody who's investing over that long time frame. Because typically, the recessions, they don't take 40 years to recover. They typically take between 5 and 7 years, which is still generally within most of our time frames. And so that's something important that we have to keep in mind. So Monte Carlo simulations, I'm just going to tell you what these are. We're not going to get into the weeds of how they're used and all that kind of stuff. But this is the kind of stuff that we'll do when we run financial planning simulations through software. So essentially what it does is we look at all of the historical market data that we have as a foundation, all of the returns that have happened ever. You can kind of think as every single day, month, year as a different starting point upon which we can take our numbers and we can plug them in and start with market returns from there. So we're also introducing random variables. So we'll have all of the pre-existing scenarios. Then we'll also take all of those scenarios and just randomly tweak them to see if how different stuff changes the outcome. And that helps us test all of our inputs against a range of market environments. So you'll typically see this in a financial plan. If you've ever gotten a financial plan done, you're probably going to have a page that has some percentage value on it, like a confidence score or a probability of success or something along that line. That is usually telling us, okay, in how many different scenarios do we make it all the way through and our end goal is positive and we don't run out of money too early? So this helps us determine what our optimal withdrawal rates, because different withdrawal rates will make different circumstances happen differently. For example, if I'm taking out a fixed dollar amount out of a portfolio, you might be taking 4% today. But if the market declines by a significant amount, that percentage now increases by a lot. That same $50,000 could be worth 10% of the portfolio, 12% of the portfolio. And that makes a much bigger difference, because if we're taking $100,000 and let's say we take 4%, $4,000 out of it, $96,000 still gets to participate in whatever growth we've selected. But if $12,000 now has to come out, or it's dropped all the way down to $50,000 and that same $4,000 comes out, only about $46,000 gets to participate, and it's not going to grow at the same to the same dollar amount. It's going to handicap us by a lot. So we have to figure out what kind of withdrawal rates, what kind of distributions can we take without the plan probability suddenly just crashing through the floor and becoming really low. And so this also helps us generate our needed savings rates if we're in the accumulation phase, and it also helps us experiment with assumptions. So we can change whatever we assume inflation to be, what our return's going to be, what our tax rate's going to be, and then it gets expressed generally as a confidence level or a percentage of probability. So usually you'll see this reflected as maybe a 93% or a 95% or a 68%, some percentage level that says in 70% of scenarios, this works out fine. Typically, we like to massage things until they get to 95 or higher, but yeah. Yes.
I was wondering about that. I get one of those probabilities
Mhm.
percentages, and in the software, they were saying anything over 80, they consider pretty good.
Yeah.
But then I was thinking, well, if in 20% of cases, I'm gonna run out of money, that doesn't sound very good, right? So how
Right.
weird are those scenarios that the Monte Carlo runs? Like, are the 20%
Yeah.
things that are really strange, like 3 COVIDs after
Yeah.
another, or?
Yeah, so when we're getting to those more smaller bits, the 20%, that's going to include things like 2008, COVID, maybe COVID back-to-back a couple of times. There will definitely be a decent amount of sort of black swan events that get included in there. But I usually would want to include, I want to get up to 90% personally. That's kind of where I feel more comfortable. So if I can get to 90% plus, I feel like we're doing pretty all right. Because, 2008 was a while ago, but then again, it wasn't all that long ago. That could have infected many people's investment plans here today. And you may have recovered, you may have not, and you may have seen what happens from there. So it's important that we calculate for those. And sometimes you may just not have the level of investments that are needed to get that percentage all the way up there, but we do what we can. No worries. More technical difficulties. All right. Okay, so to sort of visually represent how Monte Carlo works, we've got it here, but with simulations of a stock price. So we're just assuming that we're using Apple stock, and it started at $145 or something like that. So this is kind of what it looks like. You basically have your investment portfolio, however it's allocated, and you'll have all of these different scenarios that can take place. And what we're trying to do is make sure that we have our plan work out in not just the ones where the stock appreciates by a whole lot, but also have it survive a circumstance like this, where the stock price falls considerably. So many different simulations will be run. Typically, it's thousands and thousands and thousands of simulations. It's not just a couple things done by hand. There's a reason that we have very expensive planning software that helps us out with this, because it runs a whole lot of these scenarios back to back with a ton of different multipliers so that we can see exactly what sort of outcome we're having. And again, if you've had those financial plans, this is kind of what it's going to look like. Is they might present you with a couple different alternates, like if you had this much spending, you have a 93%, and as you increase it, it slowly decreases, because again, like I mentioned, if we're pulling that out of investment accounts, if the stock market drops by a lot, the percentage of those assets that we're taking increases, which then reduces our amount of principal that gets to earn interest to pay for that. Yes?
Are all Monte Carlo simulations the same by various investment companies?
I would say at this point, it's probably a statistical probability that they're all very similar, just because of how many different simulations are done. They probably overlap a whole lot. Yeah, it's going to be pretty similar.
Historical data only?
Not only, so it uses historical data, but then it also applies modifiers to the historical data. So to say maybe instead of a negative period that only lasted 5 years, they might increase it to 10 years. I haven't done a full study on every single way that they run a simulation, but they take that historical data, every different start date that you could have, kind of all the way from the beginning of the stock market to most recently, then they'll also apply modifiers to all of those scenarios to get an additional layer that kind of is like a forward-looking, but because we obviously can't predict the future, but that's kind of how we get our modified outcomes that are a little different.
Shared by all the respective stock exchanges also?
Yeah, exactly. Yeah. So it's a whole lot of data.
And who's the custodian of the data?
Well, I mean, a lot of that data is public nowadays, because a lot of those stock market returns you can get from a lot of different sources. But yeah, there's a couple different companies that'll do it. I know InvestNet is one. They do Money Guide. There's a company called Right Capital. That's who I use. And I think eMoney is one that's been around for a long time. A couple other different ones. But yeah, there's a few different providers. Okay. So now that we've talked about estate plan, or now that we've talked about investments, one of the next most important things is to talk about estate planning. So we start with cash flow, because obviously we need to pay for something somehow. We need to know how the money comes in and out. We move to the tax planning, because the taxes will directly affect how much cash flow there is. Then we look at the investments, because the investments help us sustain the cash flow. And so now that all that maybe is evaluated and put together, it's important that we look at the estate planning, because now we're preparing for unlikely events or past death events or past maybe the inability to make decisions, a whole bunch of different stuff. So now we're looking at protecting these assets or making sure that they distribute properly once you pass. So there's a couple key components of estate planning that we want to make sure we understand first. If you probably have a will. I would hope that everybody here has a will. And that works for small estates if you don't have a lot of value, if you've got pretty simple stuff going on, or if you want to just make sure that your personal property goes to the right place. Wills are great for that. But if we get to a much larger estate, things start getting complicated. We have more beneficiaries. We have more different ways that we want the assets to go, and we don't want to just sort of go, here, take all of it and split it in a couple different ways. Maybe we want some more specific instructions. Trusts become incredibly useful for this. This is both for the large estates and for specific instructions, but it helps us determine exactly how and when transfers will happen and what method of transfer is being used. Now, beneficiary designations, this is the thing that if you take nothing else from this section, really want to make sure you understand that you need to get your beneficiary designations updated right now if they're not. And if there's anything blank, please go update it and put a beneficiary in there right now. Beneficiary designations essentially just say, when I pass, take the value of this account and transfer it to this person. And this happens via something that's called contract law. And now one thing that's important to understand about contract law is it supersedes the previous two directions of estate planning. Wills and trusts actually come second to beneficiary designations, especially at big financial institutions. If I get instructions that an IRA is to go to this beneficiary at death, even if an executor comes to me and says, hey, look, the trust says split it 3 different ways, I go, listen, I signed a contract with the client previously, I have a social security number, I know exactly where I need to put this, and that supersedes my need to listen to the trust. I have to distribute it exactly where that beneficiary designation says. Now the executor can contest it, but then that just starts drawing out the period of time upon which all of this is going to happen and increasing the cost. Yes?
I thought when you created your trust, you created beneficiaries and TLD on all your insurance policies. So is that, if it's in the trust, is it, if I have a trust and I have beneficiaries listed in that trust, and on some accounts a TLD, is that sufficient, or do I need to do something else?
So there's a couple different things that can happen. So I'll just kind of say a couple different scenarios. So you might have an individual brokerage account with a transfer on death, and it goes to the trust. That moves that account upon your death into the control of the trust. Now whatever beneficiaries are listed there, it'll follow those instructions and disperse them. Now if I have an IRA, and my beneficiary is not the trust, it's going to go to whatever the beneficiary that's named there is. So typically when you do these things, they will instruct you to go update all of your beneficiary designations everywhere to the trust so that it directs over there and then gets directed by the trust. But I have run, I just ran into a situation. I have somebody signing up with me now, and she didn't realize she had to do that. So all of her accounts don't actually match what the trust is supposed to do. The trust just kind of is there. The individual account never got re-registered into the name of the trust. It never got a beneficiary designation for the trust. The IRAs, also none of them are directed to go to the trust. So it wouldn't really even matter what the trust says because those contracts are already in force. They supersede just requests of the trust or will. Yeah.
You also want to make your beneficiary designations to your bank accounts.
That's right. That's really important, especially for individual accounts that are just registered in your name, because there's no beneficiary automatically attached to that. You can put a transfer on death provision that kicks it right over to where it needs to go. So I would take a look at that if you've got individual brokerage accounts or bank accounts, insurance policies, everything. Just if anything's got a beneficiary designation, make sure it's the right thing. And the trust is the really easy catch-all. So if you don't really know, just put it in the trust. And then if it doesn't have a beneficiary designation, figure out how you can work it into your estate plan in a way that doesn't have to go through probate.
So if you don't have some of these designations going to your trust, does that mean then that's subject to probate, or are there some,
Not necessarily.
I'm saying like, for example, an IRA?
Mhm.
Is an IRA subject to probate?
If an IRA has a beneficiary designated on it, it is not. So anything that has a beneficiary, whether it's the trust or somebody else, that skips over probate entirely.
Okay, so that includes bank accounts?
Correct.
and-
Yep. Yep. So as long as there's a beneficiary on it, probate's not a concern. It just will directly go to that beneficiary.
But now homes, you need to put those in a trust, right?
Yes, and I believe you can also put a transfer on death provision on those as well. So same thing. The transfer on death is just basically something you can add to an account that doesn't already come with a beneficiary designation. And it's just kind of like saying, hey, can I get a side of a beneficiary designation with that? And then it transfers at the end. Yes?
So if you have most of your assets in brokerage accounts and bank accounts, and you have your transfer of debt and all those beneficiaries laid out, a trust isn't that critical at that point.
Not necessarily, but some people like to have the trust be the beneficiary of the assets, especially if what's supposed to happen is that the money doesn't go to the beneficiary immediately. So if all you want is the money to just go right over and they just inherit all of it immediately, they have full control instantly, that's totally fine. But if you want to spread it out over time, if you want to have maybe some rules for the beneficiaries, that's not really going to serve you because they're just going to get the money immediately and do whatever they want with it. But if you want to have a couple restrictions, let's say, or you want it to go to certain costs, that's when trusts really become important.
Control from the grave, right?
Exactly. Yeah. Yeah. And there's also there's also additionally what you could do as well with trusts is give different types of benefits. So just inheriting the asset is only one kind of benefit. But you can also give a use benefit for a piece of real estate. You could say you can live here until you die, then this other person gets it, or it goes to charity or whatever you decide. You can do income benefit. So if you've got a brokerage account and it generates a whole bunch of dividends, you can have somebody just get those dividends for life. And then when they pass, you can donate that to charity or give it to another beneficiary. And so this often happens when you have a spouse and children, because you want to give the spouse the use and the income benefits, but then when they pass, then you want to transfer the assets over to the children. You don't necessarily want to transfer them all over to the spouse immediately because you want to make sure that your wish of the children is being fulfilled, and you don't necessarily want to transfer it immediately to the children because you still want the surviving spouse to have the comfort over the rest of their life. So through those a little bit more complicated planning scenarios. You'll do that wherever the account is held. So if you have a brokerage account, you just go to your brokerage firm and ask them to do it. Yeah, I believe so. I'm not 100% sure on that, but just check with wherever yeah, you can absolutely, yeah, you can go there and they'll be able to help you put a transfer on death on that. So the last thing on here is our power of attorney. Now, I'm going to be very upfront with you. This year, we have seen a lot of scenarios where this would have been really good to have set in place, and it wasn't set up properly. And so now we're dealing with the struggles of trying to help people who may not have their full capacities or may be unavailable to communicate with, but there are just kind of, we don't have somebody who can be in control, or there's somebody who's supposed to be in control, but they never signed the other proper pieces of paperwork that, all came together. So we've got two different types of power of attorneys, or POAs. We've got a medical, and we've got a financial and legal. Our medical power of attorney, or our living will essentially give somebody control over what medical decisions happen to us if we're not there to make that choice. Both of these documents, if you already have a trust, you probably made them already. So even if you don't remember it, it's almost always included when you create your trust. Yes?
I looked it up. California does have a TOD for vehicles.
Fantastic. Additionally, the financial and legal power of attorney is also incredibly important because if you're taking distributions from an account and it's funding something and maybe we have a new need that we need to pay for, or we have continuing expenses and we don't have, say, a recurring payment set up, or it needs to go to a different account so somebody else can help pay your bills. If I don't have a financial or legal power of attorney on file, I can't listen to anybody but you. Until you die and it goes into the power of the trustee or executor, I can't listen to anybody but you if I don't have a power of attorney. They can't actually make any decisions. Even if it's a spouse, I can't just automatically listen to them unless they own the account with you. So it's
How does
really,
the power of attorney kick in?
it
Like,
depends.
Let's say
Yeah.
Let's say I've lost my mental faculties, but I think I'm fine.
Yeah, so there's a couple different ways that it can kick in. So there's the first kind of power of attorney. Well, first let me get through sort of the two basic types of power of attorney. There's a general power of attorney, which just gives sweeping powers so that they can do whatever they need to do. And there's a limited power of attorney that specifies exactly what they're allowed to do. Now, also, a power of attorney, if it's just a regular power of attorney, goes into effect the moment you sign it. A durable power of attorney will continue through your incapacitation. So a normal power of attorney doesn't actually survive if you become incapacitated, which is a little strange, but it's kind of just to protect you. Like if you go out of commission and then this person goes and makes a whole bunch of decisions against your will, you can't stop them if they have a power of attorney. So the durable power of attorney, it continues through incapacitation or some sort of illness where you don't have full faculties. Now, a real answer to your question, there is what's called the spring forward or springing power of attorney. What this does is it waits for a predetermined event to happen or some sort of qualifier. Typically, this will be a medical professional signing off on some sort of document that says they've lost their faculties, they can't make decisions, they're not in sound mind anymore, and then that will be taken to whatever institutions or lawyers or what have you, and then the power of attorney will become active. And then at that point, it survives until you pass or you come back from your incapacitation, and then it will go back away. So, let's talk about probate a little bit. Let me tell you why. Well, let me just kind of tell you about how things function. So if you've got your estate, let's assume we have no planning documents, no nothing. We don't have anything set up. We just got a will maybe. We've got a nice big estate. If you don't set anything up, if there's no directions, there's nothing at all, it's going to go right over to probate court. And then probate court will look at your will, they will consider your will, and then they will make a determination of where the assets are supposed to go. Maybe it's in line with your will, maybe not. Maybe a previous spouse comes and has a really good argument to why they deserve half of your estate. Maybe a child comes forth and is really convincing to that judge of why they deserve a piece of the pie. If they're convinced and they find a good reason to split that estate, it's going to happen. But if we have a trust or a beneficiary designation or some sort of contract that determines exactly where those assets are going to go before you're passing, we get to skip right over that probate court. And we get to go right beyond it and go straight to our beneficiaries. There's a couple reasons why this is a good thing. Probate typically takes 12 to 18 months in California. So that's a year to a year and a half. If it's necessary that somebody gets their assets right after your passing, like what would be very important for a surviving spouse or any dependents, that 12 to 18 months could be kind of a rough scenario of a delay of asset transfers. Additionally, the fees at probate, they don't care if you have any debt. If you've got $1 million of assets and $500,000 of debt, that debt doesn't really matter to them. They're going to charge you based on the gross assets that you have. So they're going to run that calculation of fees based just on the gross assets and just completely ignore the debt altogether, even though you don't actually have a net worth of that much. Additionally, and this can be kind of rough, probate proceedings are public, fully public, which means every dollar you have, every asset, every place that it went, every person that benefited is just out there, just in the open. And it really opens the door for drama between beneficiaries and just anything poor that could happen. Having money changes people. Let's be real. Money can really make a difference in relationships. I hate to see it, but sometimes you'll see that beneficiaries start to change a little bit when they start to see exactly how much money could hit their bank account upon the passing of whoever's estate it is. So having all of that be public can create quite a bit of drama or unnecessary conflict that we could otherwise keep hidden away and make sure that our people are taken care of. And again, those assets can be distributed in just a way that you did not intend. It could just go any which way. Now, talking about that California probate fee schedule, let's take a look at what it is. So again, whatever representative that gets appointed is going to get paid based on the value of the estate upon these following calculations. First, 4% on the first $100,000, just flat. And remember, no debt doesn't count to this, it's just the assets. So we get 4% on the first 100,000. They charge 3% on the next 100,000. They charge 2% on the next 800,000. And they charge another 1% on the next 9 million. And then once we get beyond 15, or we get 0.5% on the 15 million, and then for all amounts above $25 million, they just figure out whatever it is themselves. They might determine a rate that's decently higher or decently lower, but then again, now it just becomes a variable, something we can't determine at all. So there's a couple different examples of what we might seek to do with estate planning. We're not just giving cash to our kids. We're not just letting our surviving spouse live in a house. There's other things that we might want to do. So there's three main categories that I kind of like to think of this in. We've got charitable giving. So if you like to be charitable with your money, there are some really good strategies that we can use to do that in an efficient way. For inheritance, obviously that's the easy one. How are we passing assets to our beneficiaries, and is it occurring in the way we want it to? And then thirdly, asset protection. So it's not just about transferring the estate, it's also about maintaining it and maybe creating some separation of liability so that mistakes that we make in our lives don't drain the estate by too much. When it comes to charitable giving, you can set a beneficiary or a transfer on death provision. You can make that a charity if you want to. So if you've got a big brokerage account, you got nobody to leave it to, or you just don't want to leave it, you could put a charity as the beneficiary of that, and it'll just disappear out of your estate, go right to the charity, and they'll be able to use it for whatever they need to. Qualified charitable distributions, we've talked about a couple times. If you've got an IRA, you can do what's called a qualified charitable distribution, or a QCD, up to, I think this year it's $105,000 still, and you can directly donate that to a charity, and it's basically never recognized as income on your tax return. So if you've got RMDs coming up where you're taking them already, and you just don't really need them, you can pass them over right to a qualified charitable distribution, straight to a charity, and not have to worry about paying the taxes on that income. Thirdly, donor advised funds. So this is sort of an intermediary account that you can establish at a brokerage firm to where you can put cash or you can put appreciated securities into, and you can get a tax deduction for it this year while still not deciding exactly what charity it's going to. So you might not have figured out exactly where you want to donate things, but you know you want to be charitable and you really could use some help on your taxes this year. Well, we can put our funds into a donor advised fund and we can leave them there and they'll get managed by the brokerage firm, and then we can decide later, all right, I'm ready for you to pass it to this charity at whatever time we please, and then it will pass along. But we got the tax benefit in the year we put it in the donor advised fund. So a benefit for this, I'll tell you about another client example that I have. It was a trust account, a revocable living trust account, and she wanted to get a little bit of a deduction on her tax return. We also were sitting on some individual stocks that were very appreciated. It was NVIDIA, so we had a lot of money made on that position, and she was ready to do a charitable deduction so that she could lower her taxable income a bit. I had her open up a donor advised fund at Schwab, and we put $20,000 of this NVIDIA stock in there, and she was able to deduct that directly against her ordinary income and then just leave it in the Schwab account for a little bit until she finally, a year and a half later, decided, all right, now I know who that's going to go to. But she was able to get the tax benefit when we put those appreciated stocks in there. And you're able to deduct the full value of those stocks, not just the gain on them. Charitable trusts are where we start to get into a little bit more complex planning. There's a couple different types of charitable trusts. One of the, I would say, most frequently used and the most easily understood is the charitable remainder trust. The way that this works is, I was just recently talking about how you can give more than just the inheritance benefit of all the assets. You can give a use benefit or you can give an income benefit. Now, if we established a charitable remainder trust and we put a whole bunch of money in there that generates some amount of income, we can say, all right, I'm going to put my assets in this charitable remainder trust. I'm going to take the income from this, but the remainder beneficiary, the person who gets whatever money is left over once I pass, is going to be the charity. The benefit for this is that you also get the deduction on the money on the way into the trust, and then you pay a little bit in taxes on the money as it comes out. Because you took a deduction against it, you have to pay some taxes as it comes out the other way. But then this means that you get that tax benefit up front, and you've already planned for your charitable giving. Once you pass, the remainder of all those assets go on to the charity. For inheritance, there's a couple different things that we can do. Like we said, beneficiary designations, transfer on death. Yes, question?
So the question about the charitable.
Yeah.
That's only 501c3s?
Yes, correct.
And you still have to meet the requirements for taking the charitable deductions anyway in that year? So
yes, correct.
You'd have to have a long form. You couldn't
Yeah.
use the standard deduction.
Right, correct. You would need to itemize and follow all the different restrictions that apply to that. Yes?
You know, the QCDs, there's an age thing, right? You have to be getting the RMDs to use those.
Do you remember what the age requirement on the QCDs is?
I don't know on that. Obviously on the RMD it would be the
Yeah.
73.
And if I remember, it's a little bit earlier than the RMDs that you can actually do. Yeah, 70, right? Yeah.
And what about the other two, the donor advised funds?
Those don't have age requirements. Those are just whenever you want to do it. Yeah. So the QCDs, you can actually do those as early as 70 instead of whatever your RMD age is. So you can start doing them a little bit earlier. Now, when it comes to inheritance, we have a couple different methods upon which we can leave assets. We mentioned previously beneficiary designations, transfer on death. Those are kind of the simple ones. Revocable living trust, again, sort of a trust that shares your Social Security number, but that can help direct those assets. Wills can help, but typically they're better for the smaller estates. A special needs trust is something that can be pretty useful if you have a beneficiary that gets government benefits or other types of compensation for being disabled in some sort of way. So if you need to preserve those benefits and maximize that income, you can actually fund a special needs trust. The only caveat is that the special needs trust can only pay for day-to-day living expenses. You can't start buying them nice cars and luxury goods and all sorts of stuff. It still has to be for day-to-day living expenses. Now, kind of going back to the top, family limited partnerships are an interesting way to leave family businesses. So if you're sitting on a sole prop business or some sort of general partnership, you can create what's called a family limited partnership, where essentially what you do is you maintain control of general partnership shares, and then you make 99% of the rest of the shares limited partnership shares. And those limited partnerships, because they don't have any control over the day-to-day actions of the business, you can leave those to your kids over time, over the years, or through a trust of some sort, but not give up control of the business until you finally pass, and then that moves on to whoever's next in line. So the reason that that can be helpful is because we have what's called our annual exclusion for gifting. When you gift assets to somebody, there's a certain amount that you can do tax-free, gift tax-free, and then if you donate over that much, you have to start eating away from your estate tax exemption, that $15 million, which for most of us is going to be considerably more than our assets. But if you're pushing that number, or maybe you have 10 million, if you erode 5 million of it over time and the assets continue to grow, there's going to be some estate taxes left over.
What is that amount you can give?
So,
30,000 for a married couple and.
yeah, so 19 for single, 38 for married. Yeah, that's up $1,000 from last year. Now, asset protection, you know, there's the basic stuff that we can think of, especially as we think about our children, the prenuptial agreements, especially if we're leaving assets, if we're leaving them into their own names or there's certain accounts. We want to make sure that things are accounted for and that we know exactly whose is what, and if it stays separate, that it stays separate in the right ways. However, one thing to know about inheriting assets, if a married person inherits assets, they don't necessarily automatically become part of marital assets. So they don't immediately become joint assets if they're inherited. As long as they're kept separate from any joint assets or commingled funds, monies that are inherited typically are excluded from divorce proceedings. So if you have a married child and that's a concern for you, just make sure that's communicated and they keep it separate so that it's not considered in those proceedings. Yes?
Is TOD considered inherited?
Yes. Yep. Anything that transfers because of death will be considered an inheritance. Yeah. And as long as they keep that separate, because if they were to liquidate that and then chuck it in their joint account with their spouse, we lose that. And it just all becomes commingled funds, and it's all part of the marital assets. Now, additionally, we talked about a revocable living trust earlier, but we also have what's called an irrevocable trust. So the difference between those two accounts. A revocable living trust is something you can put money in, you can take money out, you can just kind of dissolve it whenever you want. It's not really a separate entity from you. It's more, I like to think of it more as an organizational document. It's just kind of a stronger will in some ways. You can title assets in the name of the trust so that there's no confusion about where they go. But at the end of the day, those are still considered your assets. So there's no separation of ownership. It's still yours. The reason for this is because a revocable living trust will operate under your own Social Security number. Now, with an irrevocable trust, we're actually creating a new tax entity. We're creating sort of a new person. They get their own tax ID number that's not your Social Security number. And when you fund it, when you contribute assets, you're actually giving up control. So you're letting go of these funds, and you don't get to determine what happens to them afterwards. And if you do, then they just become considered part of your estate again. So typically with an irrevocable trust, you want to maintain sort of arm's length from these assets because you don't want it to be considered your assets. Because typically what we're doing is a couple things. One, if we get it out of our estate, which is what an irrevocable trust does, two things happen. One, they're not our money anymore. So anybody who's coming after us for our money, they can't include that as part of what they're going for, whether it's a lawsuit or divorce proceedings or anything of that sort. They can't touch that money anymore. But neither can you. Secondly, what this does is because it's out of the estate, it doesn't count towards the estate exclusion. So that $15 million estate exemption that we have that gifting eats away from, if we move money towards an irrevocable trust, once we pass, it's not considered part of our estate anymore. It's a totally separate thing. A trust, an irrevocable trust is a separate entity that kind of lives on its own, pays its own taxes. Now on that conversation of paying its own taxes, trust tax rates are significantly higher than personal tax rates. So typically, when we deal with an irrevocable trust, for tax reasons, usually if income comes into the trust, so that could be a taxable distribution from an IRA, if it inherits an IRA, that could be dividends and capital gains, that could be some sort of annuity payment, what have you. Because those tax rates are much higher, typically what people will do is they'll have assets land in the trust and then immediately get paid out to an income beneficiary so it can get taxed at their rates instead. Because if it doesn't stay in the trust for very long and it just moves out straight to the beneficiary, the trust doesn't pay any taxes and the beneficiary does. But if it stays in the trust for too long, I don't know what the time period is, but if it stays in the irrevocable trust, it can get taxed all the way up to 40%. And that happens pretty quickly. The tax brackets for a trust are way smaller than they are for personal taxes. You also have what's called the homestead exemption. So for your personal real estate, for your personal residence, there's a decent amount of your equity that can actually be excluded from sort of lawsuits and any sort of people who are trying to come and take your assets. So it kind of depends on your area. In California, there's like an average where it's up to, I think, the average of your neighborhood or some predetermined number, whichever one is less. So it kind of depends where you're at, but it helps protect a decent amount of that. So personal residences do get a little bit of extra protection. Lastly, just for sort of, for fun, talking about business risk, limited liability corporations can be very helpful. I'm sure if you've ever been in business, you will know this, but there's one caveat for California, which is interesting. When it comes to LLCs, if there's only one member of the LLC, California doesn't really consider there to be any protection for that. They just go, it's just your asset anyway. So they look past it. They basically pierce straight through the protection of the LLC and go, that's just your money. We don't care that it's in an LLC. Now, if it's owned by a different trust and all these other more complex things, we can get that protection back, but it's just something to know. Okay.
I have a question on
Yes.
trust, just
Yeah,
real
yeah.
quick. Can you have like both an irrevocable trust and a revocable trust?
Yes, you can. And you can have more than one trust.
Would there be an advantage to ever doing that?
Possibly. Most of the advantages with the irrevocable trusts are, one, getting it out of your estate. So if you have just a ridiculous amount of assets and you need it to be under that 15 million, that could be something. Also, if you want certain assets to not be touched, if you have some sort of lawsuit or divorce or any of that, if there's certain assets you want to be completely protected, the irrevocable trust would be better for. Yes.
Just wanted to note that if you're a married couple and you have a trust, it will often provide for dividing your estate and having half of it in a decedent's trust, which becomes an irrevocable trust on death of the first spouse to die. And so
Right.
then the rules pertaining to irrevocable trust would apply to be taxed at trust rates.
Yeah, correct. So basically what he's talking about is having a revocable trust when you're married, and then when one of the spouses dies, it will convert into an irrevocable trust because one of the members has died, and then you get those protections of an irrevocable trust over the living trust. So, yes.
We passed over this, but on the special needs trust,
Mhm.
is there, a particular criteria that the beneficiary has to meet to be able to be put into a special needs trust? And then the other part of that was that you said it would be for them to have money to pay for their needs.
Mhm.
How do you determine that?
Yeah. So first of all, the benefits only will really apply for a special needs trust if they're getting some sort of other benefit, some benefit that they would disqualify for if they got extra income. And then there's some level of disability that you need to hit. I don't remember whose definition it is, but I do know there is a specific definition you need to meet. And then living expenses is pretty much going to be your basic things like food and housing and medical expenses, just sort of nothing discretionary, just pretty much all your fixed living expenses at that point. Yes?
If a trust is going to receive a charitable distribution, does it make a difference between revocable and irrevocable as far as the charity is concerned?
So if it's going to, you're saying if it's going to distribute a charitable contribution out of it to a charity?
Yes, if the
Okay.
trust, right.
Yeah.
And if the charity is designated as a charity in the trust.
Yeah, so I think when it comes to an irrevocable trust, I believe that you would actually get the deduction up on the front end. So you would be putting money in there, and if it's an actual charitable trust, those are going to be irrevocable. So it's something you can't just pull the money out of. So an irrevocable charitable trust, you would get a lot of the tax benefit on the front end rather than getting it on the back end. So you would actually get deductions for contributing to the trust. Then when you take the money back out for income needs, that's taxable. Versus if we're looking at a revocable trust, that's just your money for now. Then when you pass, it gets distributed. So there's not really a tax benefit that you're getting for putting the charity on the beneficiary, besides the fact that they just get all the money and it doesn't get taxed at that point. So it's just kind of like, at which point do you want the tax benefit, whether it's now for your income taxes, or if it's later on, you just want to have a sort of carefree way to just leave assets to a charity and not have anything to deal with at that point. Because it doesn't really give you any current tax benefits to put a charity as a beneficiary. Yeah. Okay. So really quickly, let's try and get through some of these insurance parts before we wrap up. We're close on time, but I just want to make sure you get some of this. So we talked about all those other things, but now we want to talk about insurance because we want to protect the assets and make sure the value stays. Just like with the lawsuits and divorces, there's insurable risks that can bring our portfolio or our level of assets down considerably. So we kind of think about it this way. If we've got our whole pie of assets here and some, if we have insurance that doesn't cover us fully, say we're maybe 80% covered, but we have this excess of assets that are not covered by insurance policies, well, that can get eaten up by all sorts of things. It can get eaten up by car accidents. It can get eaten up by healthcare costs. It can get eaten up by anything, liability costs. Somebody slips and falls on your property. That's going to be on you. So there's a lot of things that can eat away at it. But if we keep our assets completely covered with our insurance and even maybe more, then we're not at risk for those things happening. The cost of that, of course, is the premiums that we pay. So we have to make sure that we're reasonable. We're not spending a ridiculous amount of money on premiums just to have the insurance, but we want to make sure that we're covered in a reasonable way. So there's a couple different types of insurances that you'll want to make sure you're paying attention to. Medical insurance. Know what your deductible is, really important for that emergency fund. Know what your exclusions are so you know if there's anything that just won't get covered, period. Know what your co-pays are so you know how much a procedure is going to cost when you have it. And just make sure you keep that deductible available. Know what's covered and by how much it's going to be covered. Disability insurance, if you've got it, know what the waiting period is because these things pretty much never kick in immediately. There's always some period of time where they say, no, we have to wait for you to be disabled longer than these 60 days or whatever it is they determine. Then it will start paying. How long it lasts, what qualifies, is it just your occupation, like if you can't do your job, or is it if you can't do any occupation or any job? Because if you can't do your job, but you can still work at Taco Bell, and any occupation policy is just going to go, you can still work. It may be a fifth of what you were earning, but they don't care. So understand what type of policy that is, what your max coverage is. Long-term care, again, waiting period. It's another one where there's typically a waiting period before it kicks in and starts to cover. Know how long that's going to last, what qualifies for. Is it going to pay for all of the costs or just the lower expense costs and not the special sort of things? Again, know when it kicks in, how much it covers per day, and what the maximum lifetime benefit is, because they're typically not unlimited. Life insurance, how long does it last? How much coverage is there? What does it take to renew? Is it guaranteed renewable? Can we just renew it whenever we want? Or do we have to go take another medical exam and then they shoot our premiums up by a whole bunch? Homeowners insurance. Know what replacement costs it will cover, what the deductible is, what the exclusions are, what type of events are not covered, what types of coverage you have, what endorsements you might have. So if you have certain valuable items in the house, but there's no endorsement that covers it, they may not cover that loss. Auto, make sure that you've got as much coverage as we can, especially here as we get older and we have the cash flow to fund this. Making sure that we have comprehensive and collision coverage on our vehicles is important, but really maxing out liability coverage so that it doesn't eat into any of our assets, and making sure that our uninsured and underinsured coverage is really high, because we don't want to end up in the situation where somebody's at fault, they don't have insurance, and so nothing gets covered. We want to make sure that we're covered for that as well. And in California, typically the insurance follows the car. So if the car is insured, typically whatever insurance is on that car, if somebody else is driving, it'll follow the vehicle, not the person. So you're going to need to maximize liability coverage on these types of policies in order to qualify for umbrella liability. Umbrella liability essentially adds a layer on top after all of our other liability coverages. So if we have an auto accident and the liability is $1 million, but we get tapped out at $500,000, that other $500,000 has to come from somewhere. And if we have vulnerable assets, it's going to come from there. So if we can put a layer of umbrella liability on top, then we can take care of that as well.
Does it cover stock market losses?
Unfortunately not. I wish. Now, one thing to understand with umbrella liability policies is sometimes you will see that you have a $2 million umbrella policy. But sometimes what that really means is that you have a $2 million policy minus what your liability coverage is at the other policies. So it's actually only $1.5 million of additional. So just knowing exactly what you have, what type of coverage you have, and then make sure it covers any unprotected assets. Things like brokerage accounts, revocable trust accounts, business assets, rental properties, stuff that's not included in retirement plans or anything else protected like a homestead exemption. So there's a couple different examples of what protected and unprotected assets are. Typically, protected is usually going to mean retirement stuff. So things that are earmarked for retirement specifically by the account type, those will receive protections. So 401ks, 403bs, 457s, all of the qualified employee retirement plans, full protection. None of that can be touched. Traditional and Roth IRAs are protected up to $1.5 million or whatever is determined that you need for your retirement. So if it's more than that, it's going to be a little bit of a court thing where they determine how much of that do you actually need to fund your expenses. Primary residence, like we said, that homestead exemption covers up to a certain amount. So here it's $600,000 or whatever those other maximums are. And then unprotected assets, revocable trusts, remember it's under your social security number, so it's not a separate asset. Brokerage and bank accounts, those are completely available. And then any of your shares of an LLC or sole prop business or rental real estate that you've got. All of this is considered unprotected. We want all of those unprotected assets to be covered by the umbrella liability insurance. So again, here is our umbrella liability, and you can see my little demonstration of how it functions. Because you've got your non-retirement assets, and you've got your umbrella policy standing in between to make sure that the lawsuits and creditors and divorce attorneys can't get to these. So your umbrella coverage will step in after your homeowners and auto liability to protect your non-retirement assets. And typically what will happen is you bundle them together. That's going to be usually the most cost-effective way to acquire this insurance, is whoever your insurance agent or insurance company is, they'll usually look at your policies and then attach an umbrella policy on top. Sometimes they'll actually require that you bundle everything together. So getting an independent agent to shop around for you is usually the best bet. For our umbrella need, typically we just want to look at whatever our unprotected non-retirement assets are, and then we add our homeowners and auto liability, and that's about how much umbrella we need, because we need to account for the fact that our policy will typically be whatever total amount we're considering, including the liability coverages. So why do I need protection? Well, remember, lawsuits and claims don't only happen because you did something horribly wrong. People can get hurt on your property, and then that lawsuit comes to you. And they can also get hurt if you're behind the wheel of a car. And if it's just the wrong situation and you end up being found at fault and you end up getting sued, that's going to be something that these liability policies can help with. So what happens if the damages are greater than this liability maximum on our auto policy? Well, it has to come from somewhere. If you're a trustee, this is the one people don't think about. You could be sued for mismanagement if the beneficiaries don't like what you're doing. So they may not have the right to sue you and take your assets for just following the trust if you're doing your job. But if a court finds that you did not act in the best interest of the beneficiaries or whatever the directions of the trust were, they can actually totally take money from you, especially if it was shown that you took money from the trust for your personal benefit. So that's another reason to look. So protection might be limited in these cases from your umbrella policy. Just check with your agent for the requirements and make sure you have everything lined up. So the key takeaways from this is, one, maximize your coverage on the policies where it's reasonable, where the premiums make sense. Cover the rest of the assets with an umbrella policy. And then consider how life insurance could fit if it's necessary and if it's, again, a reasonable cost. So we're a couple minutes past, but I want to know if you've got any questions that we can answer before we go. Feel free to shoot them out.